Hey folks, welcome to a product review at Finominal. Today we're going to look at the permanent portfolio fund, which trades under the ticker PRPFX. Now, the objective of the permanent portfolio, like as contained in its name, is to provide a portfolio that generates a positive real return in the long term. And the asset manager behind the fund tries to achieve that by combining multiple uncorrelated asset classes. Now, that includes growth equities, corporate bonds, gold, silver, an allocation to the Swiss franc, to REITs, natural resources, and so on. So let's see how this fund has done. And we're going to kick off with a benchmarking analysis. And our kind of like auto-suggested benchmark is the S&P Target Risk Growth Index. And that's a simple equities bond combination. Now, what we see is that since 2009, well, the kind of total return is almost identical of these two strategies. Having said that, if we look at the Sharpe ratio over here, we do see that the permanent portfolio has generated a significantly higher Sharpe ratio. And that's of course, great in terms of, that combining more than just equities and bonds has achieved, kind of like this smoother return. Now, as discussed, the fund does allocate to different asset classes, and we can kind of like check that via a factor or returns-based factor exposure analysis. Now over here, we do see the factor beta to major asset classes. We do see that there's a consistently positive exposure to US bonds, to US equities. We also see that there's a slightly positive exposure to commodities. Now that would be the gold and silver allocation, and perhaps also the natural resource stocks. And we do see a consistently negative beta to the US dollar index. And we probably can attribute that to the Swiss franc allocation. Now, gold, silver, the Swiss franc are kind of all risk-off assets. Now, what is also worth highlighting is that from a risk sources perspective, all through the major asset classes like stocks, bonds, commodities, and other currencies do explain the majority of the returns, there is still a moderate amount of unexplained returns. Now we could improve this. The R squared of this, I think, is 0.84 of this underlying regression by simply adding more variables that we do know the asset manager is using in portfolio construction. I.e., we could add gold as a variable, silver as a variable, and then that unexplained return does go down. Now, that's from a performance perspective and also from a factor exposure analysis. But let's see how this fund has done in periods of market stress, right? Because this tries to achieve a positive real return that is a little bit less correlated to just what equities and bonds are doing. And here we can see the kind of like drawdown since 2009 compared to the S&P Target Risk Growth Index. And as mentioned earlier, this is just an equities bond portfolio, right? So very similar to the traditional 60/40 portfolio. Now we do see that the permanent portfolio has done significantly better during the global financial crisis in 2009. It's done significantly better during the kind of like market downturn in stocks and bonds 2022. Having said that, we also do see that there were periods of underperformance in 2013, 2015, and there was an almost identical drawdown during the COVID crisis in 2020. So this is kind of mixed track record in terms of risk reduction. I mean, during the global financial crisis, this was fantastic. Almost everyone would have preferred that drawdown versus this one. But in other periods, the risk was actually higher with regards to this portfolio. Now, we can also ask if this portfolio can be replicated. Now, it is worth mentioning that the asset manager is very transparent with regards to what goes in its portfolio. As mentioned, it's growth equities, corporate bonds, a little bit US treasuries, gold, silver, and so on. So it's very simple for us to replicate this portfolio just via selecting ETFs. And we've used the same allocations as per the manager's website. And what we can see here is effectively the performance of the perm portfolio, i.e. the fund, versus this replication portfolio, right, which is just comprised of 6 or 7 ETFs. And we can see that, well, since 2007, it's almost the same performance. Now, that's naturally not that great for the perm portfolio, because that means instead of paying 82 basis points, which is the price for this share class of the perm portfolio, you can simply replicate that yourself. And that kind of also concludes our short analysis of the permanent portfolio fund, which managed around $4 billion. So, the portfolio has generated an attractive return and attractive Sharpe ratio compared to a 60-40 portfolio, kind of like an equities bond approach, just by diversifying into other asset classes, right, like gold, silver, and so on. But the issue is that they're charging, 82 basis points for something that you can replicate within, 20 seconds, and you only have to pay 24 basis points for this. So there's nothing really magical to this. Hope that helps. Have a nice day.